Imagine a stream of money flowing into your bank account every month, without you lifting a finger. This is not just a dream, it's a reality for many who have discovered the power of passive income. That's the beauty of dividends. They are a reliable source of income that can supplement your earnings or even replace them entirely over time. Dividends are like getting paid to own. When you invest in dividend-paying stocks, you receive regular payments just for holding onto your shares. When you buy shares of a company that pays dividends, you're entitled to a portion of their profits. This means that as the company grows and becomes more profitable, so do your dividend payments. Why are dividends so appealing? They offer a way to generate passive income, which is money earned with little to no effort on your part, because they offer a way to generate passive income. This means you can focus on other pursuits, whether it's a hobby, spending time with family, or even starting another business. That means you can earn money even when you're not actively working. Imagine the freedom of knowing that your investments are working for you around the clock. This can be a game changer for anyone seeking financial freedom. With a steady stream of dividend income, you can plan for a future where financial worries are a thing of the past. Dividends provide a steady stream of cash flow that can help you achieve your financial goals. Whether you're saving for a big purchase, building an emergency fund, or planning for retirement, dividends can be a crucial part of your strategy. Whether it's early retirement, travel, or simply peace of mind, dividends can pave the way. They offer the financial security and flexibility to live life on your own terms. Not all dividend stocks are created equal. While they all provide a return to shareholders, the way they do so can vary significantly. Just like there are different types of businesses, each with its own unique model and strategy, there are different types of dividend-paying companies. Let's explore a few of the most common categories to understand their characteristics and benefits. First, we have blue-chip stocks. These are the stalwarts of the stock market. These are shares of large, well-established companies with a long history of paying dividends. Think Coca-Cola, Johnson & Johnson, or Procter & Gamble. These companies are known for their stability and reliability. Next, we have growth stocks. These are often younger companies, or those in rapidly expanding industries. These companies are more focused on reinvesting their profits to fuel expansion. They prioritize growth over immediate returns to shareholders. They may pay smaller dividends, if any at all, but their stock price has the potential to appreciate significantly over time, offering substantial capital gains to investors. Finally, we have real estate investment trusts, or REITs. These are a unique category of dividend-paying companies. These companies own and operate income-producing real estate, such as shopping malls, apartments, or office buildings. They provide a way for investors to gain exposure to the real estate market without having to directly buy property. REITs are legally required to distribute a significant portion of their profits as dividends, often making them attractive to income-focused investors. This legal requirement ensures a steady stream of income for shareholders, making REITs a popular choice for those seeking regular dividend payments. Choosing the right dividend stocks is crucial for building a successful portfolio. It's not just about picking any stock that pays dividends. It's about selecting the ones that will provide consistent and reliable income over time. It's like assembling a team of all-star players. Each stock in your portfolio should play a specific role and contribute to your overall financial success. Here are some key metrics to consider when evaluating dividend stocks. Dividend yield. This tells you how much dividend income you can expect to receive for every dollar you invest. It's a crucial metric because it directly impacts your cash flow. A higher yield generally means more income. However, be cautious of extremely high yields, as they may indicate potential risks or unsustainable payouts. Payout ratio. This indicates the percentage of a company's profits that are paid out as dividends. It helps you understand how much of the company's earnings are being returned to shareholders. A lower payout ratio suggests that the company has more room to increase its dividend in the future. This can be a sign of a company's financial health and its commitment to rewarding shareholders. Earnings growth. Look for companies with a history of growing their earnings over time. Consistent earnings growth can lead to higher dividends and a stronger stock price. This is a sign of a healthy and profitable business. Companies that can grow their earnings are more likely to sustain and increase their dividend payments. Debt levels. Companies with high levels of debt may be riskier dividend payers. High debt can strain a company's finances and limit its ability to pay dividends. Look for companies with a manageable debt load. A strong balance sheet with low debt levels indicates financial stability and a greater ability to maintain dividend payments even during economic downturns. Diversification is key to managing risk in any investment portfolio, and dividend investing is no exception. Don't put all your eggs in one basket. Spread your investments across different sectors and industries. Think of it like this. If you invest all your money in a single company, and that company faces unexpected challenges, your entire portfolio could suffer. However, if you diversify your holdings, the impact of any one company's performance will be minimized. Diversification helps to cushion your portfolio from market volatility. It's like having a safety net for your investments. Section 5. Building your dividend portfolio. Starting strong, growing steadily. Building a dividend portfolio is like constructing a house. You start with a solid foundation and gradually add to it over time. Begin by investing in well-established, blue-chip companies with a long history of paying dividends. As your income grows, you can gradually add more stocks to your portfolio. Consider diversifying into different sectors and industries to further reduce risk. Remember, Rome wasn't built in a day, and neither is a successful dividend portfolio. Be patient, consistent, and focus on the long term. Section 6. Maximizing your returns. Strategies for dividend growth. Once you've built a solid foundation for your dividend portfolio, you can explore strategies to maximize your returns. One effective strategy is to focus on dividend growth. Look for companies that have a history of consistently increasing their dividends year after year. These companies are committed to rewarding their shareholders and growing their dividend payments over the long term. Another strategy is to reinvest your dividends. By reinvesting your dividends, you're essentially buying more shares of stock, which will generate even more dividend income in the future. It's a powerful cycle of compounding growth. Section 7. Managing risk, protecting your dividend stream. While dividend investing can be a relatively low-risk way to grow your wealth, it's important to be aware of the risks involved and take steps to mitigate them. One risk is interest rate risk. When interest rates rise, the value of dividend-paying stocks may decline. This is because investors may be drawn to higher-yielding fixed-income investments, such as bonds. Another risk is inflation. When the prices of goods and services increase, the purchasing power of your dividend income may erode. To combat inflation, look for companies that have a history of increasing their dividends at a rate that outpaces inflation. Section 8. Living off dividends, turning income into financial freedom. Living off dividends is the ultimate goal for many investors. It represents financial freedom, the ability to cover your living expenses without relying on a traditional job. To achieve this, you need to build a dividend portfolio that generates enough passive income to meet your needs. This requires careful planning, patience, and a long-term investment horizon. Start by determining your monthly expenses and then calculate how much dividend income you need to generate to cover those expenses. From there, you can develop an investment plan to reach your goals. Section 9. The power of compounding, letting time work its magic. Compounding is one of the most powerful forces in finance. It's like a snowball rolling downhill, gathering more snow and momentum as it goes. When you reinvest your dividends, you're harnessing the power of compounding. Over time, even small amounts of money can grow exponentially through the magic of compounding. The earlier you start investing, the more time your money has to compound and grow. Section 10. Taking the first step. Start small, dream big. You don't need to be a millionaire to start investing in dividend stocks. In fact, you can start small and gradually build your portfolio over time. The most important thing is to take that first step. Open a brokerage account, choose a few dividend-paying stocks that align with your investment goals, and make your initial investment. As your income grows, you can continue to add to your portfolio. Remember, the journey of 1,000 miles begins with a single step. Start small, dream big, and let the power of dividends guide you towards financial freedom.